We're now moving on to another topic which is very clear and dear to capital markets, particularly the African capital markets, the members of ASEA, is the debt markets. And there's lots and lots of scope for African markets to share experiences and improve what they're doing. So we're very lucky to have an expert with us. Christelle Fink is here from, she's the head of local capital markets development in southern and eastern Mediterranean region for EBRD. So she's been working with a lot of these markets. She's had a lot of experience in this before. So I think EBRD is lucky to have her to start spreading the word and spreading the actions across the region. Let me hand over now to Christelle Fink.
Thank you very much, Tom, and thank you as well to the Casablanca Stock Exchange, Karim Haji, Barder Ben-Youssef, and the team for inviting me to speak today. It gives me great pleasure to be here and to share our experience in developing debt capital markets. It's the priority of the EBRD in the region, the debt markets, and I'm going to explain why the change or the potential change to a floating exchange rate regime is actually good news for capital markets development. Okay, so the key question here is about should we fear the float or not? And actually, I'm going to show that the priority is to prepare and get ready for it, and not worry too much before it happens. So debt capital market development is a priority in Africa because, as mentioned here before, the economy of the continent is growing fast. It's the IMF reckons that it's going to be the second fastest economy growing in the world, regional growing in the world, and the demand for capital is outpacing the supply. So it's about building the bridges that will allow local savings to reach the local economy and stay in the local economy, but also international savings to be invested into these projects. So it's about improving the mobilization and allocation of resources. And one of the priorities is to create a local investor base. International investors are not comfortable being on their own. And one of the key elements is developing the mutual fund industry, pension funds, insurance sector in local currency. This is very important because a lot of the projects are going to require local currency funding. It's about building the bridges as well between international investors and local projects. So this is about legal reforms. Legal reforms are fundamental to make international investors comfortable pledging assets or taking local collateral. And it's about establishing well-governed institutions. Well-governed institutions is about the judiciary, making sure that legal decisions and judgments are consistent, but it's also establishing a very credible central bank. And this is at the core of my presentation today. It's the important role played by the central bank in starting debt capital markets. This is because the exchange rate policy matters. In this diagram, we took the countries with the biggest market capitalization of the African continent, the 13 biggest, and over the past 20 or 30 years, we see that fixed rate regimes are progressively losing ground, and there is clearly a move, maybe less evident over the past 5-7 years, mostly because of the global financial crisis, but there is a growing trend of more flexible exchange arrangements. So what happens here is that the leaders, the biggest countries and the biggest economies are the ones actually going to afloat. And we're going to see why. It's about confidence in their local economy, and it's about, at some point when the growth is going sufficiently at the right pace, when international trade, when the economy gets involved in international trade, and also when the economy is sufficiently prepared, the risk of switching to a floating rate regime are outweighed by the benefits, the potential benefits that come with it. It's about this debate between price stability and competitivity. And at some point, the economies and the central bank and the authorities become confident that competitivity in an international environment is more important than price stability. So there are two key reasons why floating rate regimes are more conducive to capital markets development. I'm going to focus, there are many purely economic reasons, but I'm going to focus just on the ones relevant for capital markets development. And the key one to start with is the economic growth argument. Floating rate regimes allow to protect the GDP growth. It absorbs the shocks and means that the GDP growth is less variable. You can see here two diagrams. The blue and the green are probably the ones you may want to focus on. On the top blue one shows the GDP growth evolution of countries with fixed exchange rate regimes. And you can see that there are dramatic shifts up, down, and at the bottom, African countries with a floating exchange rate regimes. The evolution is much smoother. We're not saying that exchange rate regime make the economy completely immune to crisis. This is not true. But what happens is that the recovery is faster, and outside a crisis environment, evolutions are just much smoother. And this is very important because the GDP output behind these numbers and this graph, you have jobs, you have companies actually, you have the real welfare of the country and the population. And in particular, it is the small SMEs or the smaller entities which are going to disappear when you reach a decrease in GDP growth. And these smaller entities, small SMEs, that will suffer most are the ones creating the jobs. So this is about also protecting the growth, because equity investors, this is one of the key elements for them, is GDP growth. It's definitely a very supportive element in any event to have a very smooth curve. The second argument is more technical from a capital market development point of view. Floating rate regimes bring a bit of uncertainty. It allows people to take a view. The curve is going to fluctuate. We are moving from a static environment to something more dynamic, maybe more active. We're moving from a model where everybody's on the same side, herd behavior, everybody has the same model, buy and hold, buy to maturity, hold to maturity, to maybe something where people take a view, they might want to sell before maturity, and economic models can vary as well. There is a clear interdependence between the development of money markets and capital markets and the monetary policy. This is very important because a floating rate regime is going to support demand for derivatives. Foreign exchange hedging is going to become a very relevant instrument, and foreign exchange elements and the instruments and repos are key elements of the money markets. Liquidity management also is going to become a priority because things are going to fluctuate. liquidity to be managed on the short-term horizon, but maybe also maybe longer, 3 months, 6 months. And then we can start building a curve. It also gives monetary autonomy to the central bank. This is important because it means that the policy can really be bespoke and matching the needs of the local economy, not being dependent on what happens in the United States and needing, for instance, if it's pegged to the US dollar, no need to defend the peg, even in a context of rising interest rate in the US dollar and maybe the local economy is not doing very well. And something very important as well is that it stimulates local currency saving. When there's a fixed peg or maybe a fixed exchange rate regime, it's, of course, we have an environment possibly with capital controls, as was the case in Morocco, but in some other countries, fixed pegs encourage savings in hard currency. The peg is kind of guaranteed by the central bank, so you might as well save in US dollar or in euro or another currency you're comfortable with rather than the local currency. And the local currency savings base is the foundation for investors in local currency, which is important, of course. So it all starts with money markets, and this is often overlooked. The central bank is the key ally when it comes to develop debt capital markets, and the central bank needs to be credible and well prepared. And when we speak about Morocco, clearly the central bank in Morocco has been working over the past 10 years. It's more than a decade that they are preparing for the transition that is ahead of us during the summer. The situation is maybe more difficult in countries that we've seen over the past months switch to a floating rate regime, in Egypt or in Nigeria. But clearly Morocco is extremely well prepared. So we're talking about the fact that money markets bring about the need, a part of the risk mitigation. I mean, a floating rate regime stimulates stimulates risk mitigation, as mentioned before, because you have movements in foreign exchange and also interest rates. It helps build a local investor base, and it means that the monetary policy is linked to the cost of liquidity. Not so much the quantity of liquidity, but the cost, meaning interest rates are going to become the focus of the central bank and market participants, the cost of liquidity. So with a switch to an exchange rate regime, you stimulate money markets, can stimulate, encourage a possibility of a derivatives market and liquidity in the other segments of the market, the securities aspect, both equity and fixed income. So how does EBRD accompany this? EBRD is a multilateral organization based in London. I'm part of a team of 12 people focusing on local capital markets development, and we contribute in two ways. The first one is in participating in the local markets. So we issue bonds in local currency in the local markets. And in most of our countries of operation, this has already happened. It creates an asset that is very good quality, not linked to the credit risk of the local sovereign, but still in the local currency. So it creates an asset where international investors can directly take a risk on the local currency, but also it's a great diversification for the local investor base. So participation as an issuer, but also as a counterpart. We are counterparts in the swap market, foreign exchange swap. We also use repo. And this is important to participate, bring international standards, and use also international documentation. Last but not least, we are investors. in equities and bonds issued in the local markets. Next to the participant side, we also work with the local authorities in this transition. And as I mentioned, in the region, EBRD has retained the development of debt markets as the priority, and we hence spend a lot of time and a lot of energy on the money markets. So we have we work only in 3 countries in Africa. EBRD is only active in Africa since the Arab Spring, and we only cover 3 countries in North Africa. We are only involved in Morocco, Tunisia, and Egypt. This is likely to be expanded, possibly. In last week, we only became active in West Bank and Gaza. It's about a week now, so which is not in Africa, but I thought I'd share with you the good news. And coming back to the money market, we do a lot of work defining money market indexes. Money market indexes are the key building block to make derivatives useful. If the index used in the money market does not reflect the interest rates in the period, or the average does not match the number of days of the period, or whatever, the instrument does not provide a good hedge. So also, there is a trend currently away maybe from LIBOR type of indexes and more towards risk-free reference indexes. So we work with local central banks defining these new money market indexes. We're currently working with the Moroccan Central Bank on that end, and also with the Egyptian Central Bank. We do a lot of work modeling sovereign yield curves. So this is about generating a curve that is using the whole history of secondary market, primary market, and money market elements. So this has already been completed in Egypt, about to be done in Tunisia, and hopefully will start in Morocco during the summer. We also create the instruments, and here again the instruments is very focused on the money markets, because money markets, as you will have understood now, is the foundations. So for instance, in Egypt, most of the asset management industry is short-term, less than 13 months, but corporates are not allowed to borrow fund at below 13 months. So we are working with the ASEA regulator in Egypt to create a short-term debt frameworks for the non-sovereign to also tap this huge pool of fund. In Tunisia, they have short-term papers, but no short-term money market funds. So we're going to do the opposite. We're going to help them create money market funds. And another type of instruments, of course, which is very relevant, is derivatives and repo. Foreign exchange swaps, repos are key instruments for money markets and later debt capital markets. This is a reform that we have been working on in Morocco for some time, and we trust will be going through Parliament in the coming 12 months. The next element is a key element of developing debt capital markets is the capacity. Debt capital markets require specific skills, which are very different from the much more broadly ones of equity capital markets. So the modernization of the central bank policy is a very important element. Some people will call it inflation targeting, but in any event, a monetary policy framework that is using modern tools and modern forecasting and modeling and communication strategy is a very important starting point. We similarly provide a training program focused on debt instruments and risk management. This is going to take place on a regional basis and being enrolled in Morocco later in the year. And we had some very good speakers earlier from Morocco. We do also support upgrades of payment systems and securities depositories. Being able to take security, money is very important for money market development. In advanced markets, since the global financial crisis, money markets have become mostly secured markets. And being able to be comfortable enforcing security taking and financial collateral is very important. So we do a lot of work with securities depositories. We are currently accompanying the CSD upgrade for government securities in Egypt. It's the largest project in our region. And another one is in Tunisia, with Tunisie Clearing. Last but not least, capital markets development is a teamwork, and it's a process. It's not something that happens overnight. It takes time and requires coordination. This is what I'm going to conclude with, that it requires coordination and teamwork between the authorities and market participants, between the public sector and the private sector. The central bank is a key element, but they cannot do it on their own. Meaning, when you're switching to an exchange rate regime, they need market participants to participate, to actually prepare, to get ready, to be a more proactive risk manager and to also more proactive manage their liquidity, because this is how the country as a whole will be able to reap the benefit of that switch. Switching to a floating exchange rate regime comes from the hope of more benefits, more benefits being reaped by the economy, and the financial sector plays a key role to achieve that. So I'm going to end with this. I'm very happy to take questions.
Thank you. Have we got some questions from the floor now about the development of this critical area and maybe bringing it further forward and into where it affects the capital markets more directly? Have you got questions? Anybody would like to start? Yes.
Thank you so much for this informative presentation. Because you mentioned Egypt many times, and thank you also for that. I have a few comments, actually, because unfortunately, the reform prescription that we have, economic reform, financial reform, monetary reform, that we have received from many international institutions over time, sometimes it was very textbookish, if I may say. Because so, go and just make your exchange rate free floating and everything will be fine. And even the data tells you that things are fine. But which data? When you go into the society, when you see the hyperinflation, when you go to see the other side of the story, to listen to it, you will find a major change, a major difference, sorry. So, for example, in Egypt, we had many success stories of floating exchange rates back in 2003, 2004. It was semi-floating, it was pegged, semi-pegged. And it was a good story to tell. Now, we were asked by the IMF, for example, to just make it freely floating. And you cannot float something in a dry area, you know, where it can float. Okay. So you need exchange rate to secure the exchange, foreign exchange sources by recovering or getting back the resources from tourism, for example, and for the inflows from international investments, FDIs. You need to get back all the traditional resources. So this is my comment regarding the prescription that we usually receive, but rarely focus on the other side. Thank you.
You're absolutely right in that switching to a floating rate regime requires preparation. it takes time and preparation, and in that regard, Morocco is very lucky because it has been prepared for the past 10 years. Unfortunately, Egypt moved into it and has been moving back and forth to over several regimes over the past 10 years because it happened very often under extreme circumstances, and these are not always the best. A fixed peg has a tendency, unfortunately, to lead to overvaluation or extreme borrowing in hard currency because or deposits in hard currency, and this creates imbalances and the highest risk of crisis, banking crisis and output crisis, GDP crisis. So I think the situation in Egypt is very particular, is very specific. It's a very painful process because of the way it had to happen, because of the very requirements of the IMF and international organizations. I think the pent-up demand that was waiting in international markets for assets in Egypt is now able to enter the country. I think we should see these positive aspects and focus on that.
Next question, yes.
Hi, I'm Mark Boland from Bloomberg. Sorry, Bloomberg Intelligence. So I just want to ask your view on the kind of conflict of, you know, the government's going for the easy option of issuing Eurobonds. I mean, that's bonds normally denominated in dollars in foreign jurisdictions against developing the local financial markets to sort of increase foreign participation and widen the investor base. And when it comes to, do you think, has this been the case, or what's your general view on it?
This has happened a lot and continues to happen because it's easy and it's comfortable, and it's a tremendous, immediate, apparent saving in terms of financing cost, but it does not contribute to the development of the local currency or the local capital markets. So it's really part of the public service. The government and the debt agency really should see this as a public service to develop the local capital markets. It's in the interest of the country to move in that direction, and we certainly are emphasizing this when we talk to them. And in Morocco, there's a clear evolution in that direction. In many countries, unfortunately, the lower income ones, there is no local domestic investor base sufficiently well developed to digest the debt from the government. So international savers step in and provide the financing. But already, if that financing would take the place of securities rather than loans, it would make already a huge difference. Because in those low-income countries, there is not even the supply of government collateral to be used to develop the local money markets. So if this financing would happen in the securities format, even if it's in a hard currency, it would already be a huge contribution towards the development of the money markets.
Maybe for me, a quick follow-up to that question. What do you plan to do about, I mean, what do you advise governments to do that are causing very high interest rates in their local money market? Because that's one of the problems when you talk to African stock exchanges, you talk to people trying to make investments, to say, well, the government's paying us 24% for risk-free, so, or 22% or 17%. Why would we do anything else? It seems the markets are being held back. What's the EBRD's words with government about that?
Okay, it's about the credibility of the central bank and the institutions. It's about communication and the credibility and consistency of decision-making at the central bank level, and then the overall recognition of the system, payment system, legal system, behavior of the government in terms of issuances, making it steady, regular, according to a program, issuing in the local currency as opposed to a hard currency. Really, it's about showing responsibility and the desire to develop the local currency and the local capital markets. So we do a lot of policy dialogue with the government debt agency, and it starts with the central bank. We provide a lot of technical assistance with central banks.
Got a question here at the back. Thank you.
Hi, my name is Kodi Ugoji, FMDQ OTC Securities Exchange in Nigeria. I want to ask a bit more about the corporate bonds. In Nigeria, we have quite an illiquid corporate bond market, even though the debt capital market is developing quite quickly. I wanted to ask if you had any specific suggestions or proposals on how we can sort of foster or generate liquidity in the corporate bond market. How do we encourage the corporates to issue bonds in the market? Because we find that there's a lot of bank borrowing as opposed to raising bonds from the capital markets.
Okay, so we do not work in Nigeria, so I'm going to give a generic answer as to how we would stimulate corporate bond issuances in our countries of operation. And this is something we do, for instance, in Tunisia or Egypt or Morocco. It's a lot about capacity building and communicating about in which circumstances you resort to bank financing and in which circumstances you resort to bonds. It's about diversification. Bank financing is like a luxury product. It's bespoke. You can renegotiate it. It's confidential. You don't need to disclose anything. So if you're working on the confidential transaction, it's the best solution. On the contrary, a bond instrument is like a prêt-à-porter instrument. It's standardized. It's going out into the market on an anonymous basis, but you have to disclose a lot of information. So it's both encouraging issuers to understand in which circumstances they are best, which instruments they are best to use, but it's also, on the other end, getting this difference in instruments to be priced correctly in the market. Today, the difference in price between the corporate, between the loan with the bank is not consistent with what you can get on a bond. Typically, a bond price should be cheaper than a bank loan. And this is not always obvious, but it's overall the pricing of the instrument in the market, which is not done always correctly. It's name-based, or it's based on a lot of collateral. It's not cash flow based. So we provide a lot of capacity building on credit analysis, and this is going to be rolled out in Morocco during the summer.
Have we got more questions that I'm missing on the floor? I've got a question for markets where people are very shy in other EBRD countries. I'm not thinking not just about Africa, where people are a bit shy about disclosing the full details of their business. Are bonds a bit of a sort of intermediary that they only got to show enough details about their business to show that they can repay the bond? It's not quite the same as an equity where you have to really open up everything.
Okay, so I'm aware of this difficulty in the countries here, but in the MENA region in particular. So we are a big supporter of private placements. For instance, we think it's a good compromise. I know it's not the favorite instrument for the exchanges, but it's maybe a stepping stone to make the issuers comfortable with a securities instrument, meaning an instrument that is sold to qualified investors on the basis of less documentation, or at least where public information does not need to be disclosed. We're also exploring, in the frame of our short-term debt framework in Egypt, the possibility of using billets de trésorerie. So these are more like papers where it's not at all, no disclosure at all is necessary, but there are some major regulatory hurdles for that. So this is just an idea for now.
Maybe in the region. Is there a credit market development in the region? Thank you.
We would definitely welcome this, but we're talking now about very long way on the road, because we need first to develop swap markets. You will be able to isolate the credit element when you are maybe already able to isolate the interest rate element on a bond. So certainly it would be ideal and perfect to have a CDS market. For now, we're going to do one step at a time, and we're going to start with foreign exchange and interest rate.
Thank you. A question right at the back.
Good afternoon, everyone. My name is Lamide Niafia, FMDQ, OTC Securities Exchange. My question is, how important is regulatory support in developing debt capital markets, and what role does EBRD play in securing that?
So the regulatory aspects are fundamental because they need to protect the investors, and at the same time, they should not be too discouraging for the issuers. And it's a very delicate balance. In some countries, it's too much on one side, and in the other countries, it's too much on the other side. And it's a very fine balance, in particular in terms of reporting or disclosure at the early on. One does not want to be paranoid, and this comes from experience. Experience as a regulator to actually become familiar with what is really needed, and it's going to take time. So we do work with regulators. We're currently doing it in Tunisia, in preparation in Morocco as well. A complete review of the supervision and regulatory environment of the fixed income market, as to benchmarking what are practices in other markets and where should we actually put the right balance in terms of supervision and requirements.
A question here in the middle. We can move the microphone up.
Right. Hello, my name is Edem. I work for a member of the Ghana Stock Exchange. I think a key component in the development of the debt market would be rating agencies. And if we back from where I come from, if we take a look at what is happening, we usually have the rating agencies rating at the strength at the government level. What can we do to get these people to come to the corporate level, since we are looking at promoting corporate bonds and all those things, so that we can get some international participation in our corporate bonds? Thank you.
Okay. On the debt side, it's very tricky because we've come to realize that investors trust mostly international rating agencies and are very reluctant to accept domestic rating agencies. And international rating agencies are so expensive that actually it's a prohibitive cost for local issuers. So in some markets, in particular Malaysia, for instance, they have developed a very good program where some of the rating costs are shared under a grant program by the exchanges, and this has worked very well. It's about really a combination of recognition by international exchanges, by international agencies, making them more proactive and more active in the market. It definitely would make a difference. Our approach is actually more to work with qualified investors, in particular in emerging or developing markets, because and not automatically requiring a rating, because a default has a dramatic negative impact in these markets. They are not familiar with it, and actually it's part of the life of a debt capital market to have sometimes a default from time to time. And it has just discourages investment. So we think it's very important to at the beginning, maybe use qualified investors to encourage the issuance for above all smaller entities.
Good, I think you guys are doing very well. Have we got some more questions? Anybody else got questions they'd like to ask? I'm really impressed. You've already, I mean, the session is running to 15:15, but you haven't stopped asking questions even though lunch is waiting. And congratulations to Christelle on bringing the subject so much alive and so much home to everybody in the room. It's been a great session to have so much participation from the different regions, and we'll carry on this trend in the afternoon. We're back at 2 o'clock, so you must eat fairly fast and come back ready for more action. Thank you very much.